Hey gang, welcome to Origination Nation. I'm your host, Chris DeMatteis, here with my main man, Steve Carpatella, and we are so pumped to have you with us today. Origination Nation is all about two things, relationships and collaboration, because that's what drives real results and success. In every episode, we sit down with leaders from across the industry who are doing things differently, bringing bold ideas to life and making a real impact. All progress originates with great ideas, and this show is about sharing what's working so others can learn, grow, and build something that lasts. So if you're all about connection, collaboration, and helping others level up, you're already a part of Origination Nation. So let's jump right in and see what we can originate together. Hey everybody, welcome to another episode of Origination Nation. I'm your host, Chris DeMatteis, and today I'm excited to have another one of our own with us. Neil Robinson, a seasoned mortgage industry veteran with 20 years going into his 21st year in the business as a loan originator. Neil, welcome to the show, man. Thanks for joining us today.
Yeah. Thanks for having me, Chris. I appreciate it. I am seasoned, but I'm not salty.
Yeah, no, you're definitely not salty, my man. No, excited to have you here. You have been in the business longer than I have, and you have a lot of experience. Tell us a little bit about how you got involved in mortgages, where you got your start, and ultimately how you navigated your way to the position you're in today at Informed.
Yeah, absolutely, man. I actually like telling this story. I got a phone call in June of 2005 from a guy I had grown up with and worked with him in a few different places, doing different things, selling hot tubs and selling pools. And he called me up and said, "Hey, man, you got to check out what I'm doing now with mortgages." And he's like, "I'm working here with, Mike Carvajal and Steve Carpatella." And I'm like, "Oh, really? It's great, So went out and I met with a gentleman named Steve Carpatella, who's now the owner, CEO, founder of Informed Mortgage. And I didn't even realize it at the time, but I had known Steve already at that point for about 10 or 12 years. We worked together when we were in high school and college. We worked together at a bar and restaurant over on Long Beach Island.
I think I know that bar and restaurant.
I think you worked there too, didn't you, at some point?
We did, yes.
Yeah. So a lot of guys and girls that are here work there, right? So I met with Steve, liked what he had to say. He explained to me what his vision was. And I started working at this very small originator in 2005, in the height of the subprime boom, right? So there we were writing subprime mortgages, honestly, not really understanding what I was doing, other than, we were selling cash out refinances to people. And we had identified very early on there that place didn't have a long-term business model. It was all about slamming as many loans in as you could, nothing to do with developing relationships with real estate professionals or our clients even, right? You talk to them once, you sell your deal, you're done. You may never talk to them again.
Yeah, it was more of a numbers game and bottom line revenue, as opposed to financial assistance and planning, right?
Yeah, exactly. Right. And we knew that wasn't a long-term business plan. It wasn't going to work forever, right? And plus it was subprime. And the more you learned about originating loans and how the financing worked, the more you realized, hey, maybe this isn't the best avenue for people. So it was a pretty short time that we all worked there, and we had decided, hey, what we're going to do is we're going to build a better business model. We're going to figure out a better way to do this because this industry is lacking in education. So we derived the plan. Everybody ended up leaving that company, kind of like a mass exodus. A lot of people went and worked different places, learned all kinds of different aspects of the industry, right? Steve went out and learned just about everything he could about product development and what products were available for people, how those products actually worked. I worked for a long time at a company that was heavily into compliance, so I have a very good understanding of compliance and the risks associated with lending money. So different guys went out, worked at different places, knowing at some point we were all going to come back together, right? And that started in 2013. When Steve opened the branch of Equity Prime Mortgage around 2013, I think, right?
Yeah.
And I think that's where you joined, Steve, right?
At Equity Prime. I was with him before that a little bit at his days at Mid-Atlantic Capital and then Equity Source. Yeah.
Yep. So I really feel like, though, the beginning of Equity Prime is when the vision started to take place, right?
Yep.
So I knew
that was when we shifted off from broker to mortgage banking platform after, Dodd-Frank and all the regulation that went into place after 08, in 2010 in that time frame.
Yep.
Yeah.
Awesome. So yeah, so that's a good example of the shifting in the business, right? So we started out with subprime, got away from that, right? That was in 2005. By 2008, subprime was dead, right? At the end of
Yeah.
2008. I remember that day distinctively. I was working at a company called Village Capital in Marlton, and the day Countrywide closed was an interesting day. Like, it was very chaotic, crazy day trying to place, you know, tens of $1 millions of loans with new lenders that really didn't want to do those types of loans that Countrywide was doing. And was the beginning of the meltdown in 2008. So, but, fast forward 2013, Equity Prime opens up. Steve starts to grow that business. And, by 2019, 2020, pre-COVID, um, the entire retail division was being run out of our office in Mount Hawken, right? And we had what, 30
Yeah.
plus branches that
Yeah.
were answering to Steve and you and Eric, right? Helping
They
run all
ended
those
up,
branches.
shifting over to like a virtual model really too at that time, right? Like,
Yeah.
cause we had so much overhead, all these physical locations, that were, costing the money, a pretty penny. So they shifted to a virtual model, and Steve took over the retail operation for the entire company at that point.
Yep. Yeah. So at that time we were, retail lenders, right? We worked with Equity Prime and that was it. Those are the only products we have. And then we got
Yep.
into COVID, right? Which was like drinking from a fire hose. It was insane. Went through some massive transitions there where we started a servicing division, which was crazy, right? It was all hands on deck trying to figure out how to process payments and how to apply escrow payments. And, I remember the boxes and boxes of mortgage payments that were coming in, sitting in the office, right? That had to be
Yeah.
filtered through.
Well, it was
So
interesting that they tasked the retail division to figure out how to service mortgages for the entire company while the company was making a heavy shift into wholesale. That's a whole nother story,
yeah, well, I think
but
they tasked the people from
yeah.
our local office to do just about everything, right?
Yeah,
To
which
some
speaks
extent.
volumes about
Yeah,
the team, right? And
absolutely.
the people here.
Absolutely.
Yeah.
Yeah. So, then we made another transition, right? So we got into COVID. Things were insane for 2 years, right? 2.5 years. Rates were at all-time lows, and it was like drinking from a fire hose, right? Like nobody had time to come up for air. And that abruptly ended, right? 2020, was it 2022? Rates went from 3 to 8% in 6 months. It was like
Yeah.
somebody turned the spigot off, right? So where were we at that point? Like, oh man, we were losing money hand over fist, like bleeding cash. There just wasn't enough originations. So decision was made, hey, we gotta transition again, right? And the entire industry at that point started moving to the broker model because where rates were and the lack of originations was just crushing retail mortgage companies,
Yeah. And the cost
including
of the
EPM.
overhead cost of a retail operation was
Yeah,
also, increasing, and decreasing margins as well, right? Shrinking
yeah,
profit margins, increasing overhead. Retail became non-competitive.
yeah,
Um, yeah.
yeah. So, talking about decreased margins. So the general public thought, wow, banks are killing it now. Rates are 8%. Right. And I had this conversation with my clients who have that perception. And the fact was, when rates were 3%, we were able to make 4 to 5 points or 4 to 5% in yield just on the rate and charge a borrower no fees. Rates went to 8% and we were making what? Less than 2.
Yeah. Yeah.
So the
Yields
yield got
contracted
destroyed.
slightly. Yep.
So raising rates doesn't necessarily mean banks are doing better.
Yeah.
A
So
lot
you
of
had a
people,
lot of people
right.
shift over to the broker model because there is less overhead, right?
Yep,
And it also opens up other opportunities, though. Now you have more buckets of money to pull from, right?
exactly. So that's the decision we made, right? That at that point is when we knew we were going to open Inform Mortgage.
Yeah.
Uh, and starting in 2022. And then we did that in November of 23. We started originating loans as Informed Mortgage as a broker, which, like you just mentioned, offered our clients tons of opportunity and opportunity for us too to provide a better service and better educate our clients. And honestly, we learned a few things,
Yeah.
right? We learned a few things that we always thought were impossible to do. Well, no, they're not impossible. We just didn't have access to it because we were stuck with one lender in the retail model. So
It's
opening up to
it's funny too, Neil. Like, you talked about how back in '08, when we made the shift and started making the shift towards mortgage banking, everybody was brokering loans back during the subprime era, right? And then, mortgage brokers got dubbed as the devil, right?
yeah, absolutely.
And the
Yep.
scapegoat of the subprime collapse. for peddling all these bad loans to people, right? These 228 arms and these risky financial instruments that they didn't really understand. But I also thought it was interesting. I got involved in the business at that time, and people thought I was crazy for jumping into the mortgage business as it was crumbling. But I saw it as an opportunity. But there was a shift at that time, right? Everybody, again, was, trying to get away from being a bad broker, such a bad negative connotation to be a mortgage broker. So they shifted to a banking platform and a retail lending platform where they, offered loan programs directly for retail institutions, limited the scope of offerings, but they weren't brokers. And that was a shift, right? So that happened for quite a long time. We had a lot of retail outlets, spring up. And now here we are post-COVID, and we're now making an exodus from the banking platform going back to brokering, right? So it's just funny how the tides have ebbed and flowed over the years, and
it's
how the market
everything that's always
like
new, everything that's old is new again, right?
Yeah. But we learned lessons back then. Learned how to qualify buyers, learned how to make sure they could afford the money they were borrowing, right? And the qualified mortgage rule and all of I think there are benefits and pros that came out of Dodd-Frank. It really cleaned up the industry.
I agree.
Professionalized the industry. But now, you have this environment where brokers are back, and there's a place for retail lending. There's a place for mortgage banking still, but it has opened up quite a bit of opportunity for us to service other clients that we weren't able to in the past with different loan programs and different strategies. So it's been exciting, as we've gotten this next chapter going.
Yeah. And as we continue to evolve, right? So we opened and formed in 2023, November, right? We just got past our 2-year mark.
Yeah.
And we've grown tremendously, right? It's been a pretty good 2 years, I think. I think what we've done is pretty impressive. And I think some of the wholesale lenders that we deal with agree, right?
Yeah.
They like working with us. We get accolades from them all the time. And what the growth has allowed us to do is transform our platform again, right? And transform into what I like to call a super broker, right? Where now we're actually able to lend money, make lending decisions, providing even higher level of service for our clients by actually lending them our own money. But at the same time, shopping the mortgage for them with wholesale lenders to make sure they're still going to get the best deal. So it gives us more control over the process, but allows the consumer to have the advantage of working with a mortgage broker by allowing us to place their loan with multiple different wholesalers.
Hey, pause there for a second, because I think a lot of people watching may be confused or just not be clear on the difference between what a retail lender and a wholesale lender are. Can you touch on that for a minute and just give a quick explanation?
So a retail lender is a lender that only offers their own products. Okay. And a mortgage broker is a company that originates, well, they don't really originate loans. What mortgage brokers essentially do is take loan applications from people, and then they'll shop the loan application to wholesale lenders. So a wholesale lender will only deal with mortgage brokers. You can't directly apply with them, right? And we deal with some of the largest wholesale lenders in the world right now, right? Definitely in the United States. So a wholesale lender only deals with mortgage brokers. Consumers can't go directly to them, right? So the advantage of dealing with a broker is they have access to dozens of different lenders that they can apply with for you on your behalf. A retail lender, you apply directly with a retail lender, and they only have access to their products, right? And some lenders may have overlays where, FHA is a great example of this, right? So you may talk to one lender who says, hey, our minimum credit score is 640 for all FHA loans. And the people who work there may believe that that's an FHA rule, right? When in reality, FHA doesn't necessarily have a minimum credit score, right? You could have a 500 credit score and still get an FHA loan if you meet certain criteria, but not all lenders will do that. So they apply what's called an overlay, right? So overlays are going to vary from lender to lender. So if you're dealing with a retail lender, right, a large lender, like let's say a Bank of America or a Chase, a Citi, right? They're retail lenders. They only offer Bank of America, Chase, or Citi products. And they're going to have overlays saying, okay, we'll do these loans, but you have to have this minimum credit score, or you have to have, X amount of income versus your debts, right? Your debt to income ratio has to reach a certain point. A mortgage broker has access to all of those products plus dozens of other lenders.
Mhm.
It's going to allow them to shop the mortgage and give the client the best scenario for them,
So,
right? So,
Neil, if like a borrower walks into a Chase or Bank of America and are told that they don't qualify because they have a 600 FICO score and Bank of America requires a 620,
uh,
that borrower, that buyer may think, oh, I can't buy a house, right? But
exactly.
in reality, they went to a retail lender, right? They went direct to the bank to get a loan, and that
Yep.
it's not that they can't qualify, they just can't qualify there.
Correct.
So a mortgage broker would have the ability to run their application through multiple different wholesale lenders, right? That don't deal directly with the public, only deal with the broker, and find a home for that buyer, because there most likely is a lender out there that would be willing to lend that person money at a 600 FICO score. It's just not Bank of America, right?
Correct.
Yeah. So the wholesale operation, the wholesale banking side, just creates more opportunities for consumers. They just can't access them directly. They have to go through the broker channel. That makes a lot of sense. So I don't think a lot of people realize that. And a lot of people are inclined, I think, to just go to their bank, right? Like, oh, I have my checking account at TD. I have my checking and savings at Chase. I'm just going to go get a mortgage from Chase or from TD or from Bank of America, because that's where my banking relationship is. But, those are large depositories and we all use them. But mortgage products are, an add-on, an ancillary product.
Uh-huh.
And banks, retail banks especially, may not always be the best place to go get a mortgage. You can, but to your point, they're going to be stricter. They're going to be tighter with the credit, and they're not going to have all of the options that are available. And most people just don't realize that, right?
Yeah, no, you're absolutely right. I mean, you summed it up much better than I did. So thank you. And the other thing about those large depository banks, the Wells Fargo's, the Bank of America's of the world, is the people you're actually dealing with are not that well educated in residential mortgage financing. They don't have the same requirements, right? So when the Dodd-Frank bill passed in 2010, the Financial Reform Act, there was a carve out. Well, let me take a step back. So when they passed Dodd-Frank, there was now licensing requirements, right? More stringent licensing requirements, credit reports, criminal background checks, and pre-licensing education, and then continuing education every year, right? Like, depending on how many states you have, a couple months ago, I completed my 15 hours for the 7 or 8 states that I'm licensed in. But there was a carve out in that rule that if you worked at and originated loans at a large depository like Wells Fargo, Bank of America, Chase City, you weren't required to get the same originator's license, and you weren't required to take the continuing education. And the argument was, well, we're so large, and it was Wells Fargo that really fought for it. We're so large, we're going to be able to train our people the best.
Yeah, the federally chartered banks. That was
Correct.
that rule. Yeah, they were left to essentially entrusted to police themselves, right, and ensure that their employees were trained and knowledgeable, but that exempted them from all of the licensing requirements, the credit checks, the background checks, the financial assessments that Dodd-Frank put in place and put upon us, right, as independent mortgage bankers and brokers, which was great. I think that implementation of those rules cleaned up the industry and really
Correct.
did legitimize and professionalize our trade. It weeded out thousands upon thousands of originators back in 2008, 2010 in that time frame. But it is interesting that those federally chartered banks weren't held to that same standard. And then to your point too, mortgages are, again, just another financial product that these banks offer, right?
Yeah.
So they have insurance products, they have financial products, they have mortgage products, they have depository products. So talk to us for a minute just about the difference between a bank like that has this myriad of financial products and services available to its retail customers versus an independent mortgage banker, right? And what the key differences are. What is an independent mortgage banker offer, and what is it that they don't offer that these other guys do, and what differentiates them?
Well, what I think it is that we do offer, that's easy. The level of service, the experience, and the knowledge is just leaps and bounds above what you're going to get from a large retail bank branch. If you can even get anybody to talk to,
Right.
right? Like, good luck walking into your local bank, Bank of America or Chase, and sitting down with a seasoned, licensed, educated loan originator that truly understands how the loan products work and understand how the financing works, what the actual costs are. Um,
And that
versus,
person that you would sit with, just real quick, if you did walk into a bank like that and you sat with one of their professionals, um, they do know something about mortgages, right? But
sure,
they are also offering all these other services as well that the bank offers, right? They're not
yeah,
a dedicated resource just for mortgage. In my experience, I
exactly.
haven't
Like,
found one.
yeah,
Did you say it's
and
the same?
I've had that experience, sure, because
Yeah.
when you go in and say, "Hey, I'm interested in a home equity loan," and they're like, "Great, this is what we have to offer," and they're really more order takers, and they're great people. I'm not saying they're bad people. They just don't have the industry knowledge or the experience to understand, what the options are for the client and what's the best financial decision for them. So you go in and ask for a home equity loan. Like, great, this is what we have for home equity loans. Oh, and by the way, um, we can offer a discount on your life insurance too, right?
Right.
and we can bundle your homeowner's insurance. And they have so many products that they're trying to sell you that really, how can you be an expert in all of those fields?
I think that's the key
So,
difference, right? Like
yeah,
independent mortgage bankers do one thing and one thing only, right?
yeah,
Residential lending on 1 to 4 unit properties. And that's it.
exactly.
That's our
Yeah,
wheelhouse. So we are a master of our trade. And to your point, with that comes just not only more knowledge and insight, but even just a higher level of service, more attention to detail,
mhm,
better communication, responsiveness, faster turn times, right? So it's actually an easier place to get educated about financing. It's an easier place to get a mortgage because again, there are multiple avenues, multiple products, multiple options. It's not just a one-stop retail lender that potentially has overlays. And again, I don't think the public realizes this, right? They just so many times gravitate towards their bank where
uh-huh.
it's not that they don't want to work with independent mortgage bankers that provide this higher level of service. They just don't know the difference. But sometimes they will find us. A lot of times they will find us. And it's interesting. I think if you look at the split, I don't know what the exact numbers are this year, but I know over the years, the proportion of mortgages that have been originated in the independent mortgage banking channel has grown significantly. Right. Obviously, you still have your retail lenders and your commercial banks and the big guys like the Chase, Bank of America, Wells Fargo. Like they're so massive. They got these huge marketing engines. It's very difficult to compete with them on that level just because of their visibility, and scope.
Yeah,
But again, with real estate agents and attorneys and financial planners and all of the trusted financial people that ultimately refer their clients places to go get financing, they're not referring their clients to the big banks, right? They're referring their clients, especially the real estate agents,
uh-huh.
to independent mortgage bankers. And I think that's a testament to the service that we provide and the service that the consumer gets, right, through that experience.
Yeah, yeah, I agree with that 100%. One of our best referral sources obviously would be realtors. Um, and they do much prefer. I mean, not to pat myself on our own backs, but we know for a fact that a pre-approval from us goes a long way in our local market here, at least, right?
Yeah.
And where we have other strong presence too, right? Like, I've been able to build a strong presence in the Tampa Bay area down in Florida through a few agents that I met with as listing agents. I had met them as listing agents on deals that we closed, and they liked the service and they liked the communication, and they were able to help us spread our wings down there. But our pre-approvals hold a tremendous amount of weight versus a large bank pre-approval.
Yeah, talk about that for a minute. The pre-approval is a big part of what we do. Especially as independent mortgage bankers and brokers, like it's a key part to the process. But why is that? Why is the level of service and the quality of the pre-approval different when you come through an independent mortgage banking channel or a broker compared to a large, retail lender or commercial lender? What is the difference?
Well, the difference is what you just said. It's the service. It's really the knowledge and the experience and the education that we're going to supply our clients. So what happens with a lot of lenders in general, and this happens across the board, whether it's a broker, a retail lender, or an independent mortgage banker, a lot of them just don't want to spend the time up front to properly qualify people, right? Their main goal is to get people committed on the very first phone call and tell them everything is wonderful and beautiful and it's going to be the easiest transaction of their life. Get them in the door, have them go out, issue their pre-approval letter because people are anxious to get their pre-approval letter right out of the gate. Issue their pre-approval letter so they can go shop. And what happens a lot of times is people end up shopping in a range well outside of either what they're qualified for or their comfort zone. So our pre-approvals, I say we're a little bit more intense up front. And the advantage to that is when you go out shopping, you are fully educated and you understand what price range you should be shopping in and what types of homes you should be looking for to keep yourself within the budget you want to be in. Because the last thing you want to do, right, especially for our realtor partners out there, is spend 4 weekends in a row, 4 or 5 hours a day, Saturday and Sunday, showing people 50 or 60 houses that they're never going to buy. Either because they don't truly qualify for them because they weren't properly pre-approved, or it's well outside of their comfort zone and they're just not willing to make a $4,500 mortgage payment. And they have no idea that that's where the payment's going to end up because they didn't have the conversation up front. So what we do, which is different, is we fully underwrite every single file. So we have underwriters on staff that review every file, and we get all of the documents up front and help the people understand this is what you qualify for. This is why, right? And sometimes people will qualify for a lot more than what they're actually comfortable with. That's my experience. So rather than telling people, hey, here's your maximum qualification, go buy a house, and not reviewing payments and not helping people understand how the mortgage payments work, let's talk about what you're actually comfortable at, right?
That's a huge question. Yeah. That's an important question. And that's not on a mortgage application.
It's not. Where do you want your mortgage payment to be?
Right.
I don't know. I haven't thought about that. Well, what are you paying right now? You comfortable with that? Yeah.
Well,
another $600-700.
I think a lot of real estate agents tell them, hey, go talk to Neil, go get pre-approved, find out how much you can buy, right? They want to know the sales price.
Exactly.
Am I showing $400,000 homes, $500,000 homes? Can you buy $600,000-700,000 homes? So we need to
and we're going to back into that.
Yeah, we need to shift people away from that mindset and mentality though, and have them start thinking about, hey, forget about the sales price, but what about the payment, right? What's the max payment that you want to make on a monthly basis when you write the check to pay your mortgage every month? Because you could have 5 different homes that are $600,000 a piece. Taxes are different on all of them. Insurance is different on all of them. Some have association fees, some don't, right? So like the total monthly payment for that $600,000 house can be different across all 5 of them. So you could be approved for, a $600,000 house with a payment that you may not be qualified for or may not want, right? So again, focusing on payment is a really important point that you just hit on.
And one of the things that you just touched on that people don't realize, especially first-time home buyers, property taxes, right? Now, for years, I've explained to clients this is more of a second home market, but they're looking for a waterfront home, right? And we live by beautiful Long Beach Island. The tax rates on Long Beach Island are super low. So $1 million home or even a $1.5 million home might have the same yearly taxes as a $600,000 or $700,000 home just over the bridge.
Yep.
Right. So you can spend a lot more money in certain towns because the tax rates are so much lower. People don't consider that.
True, even from some of the mainland towns. You could have
from town to town.
A $500,000 home that has $6,000 in taxes in one town, and you go a couple miles north, and those taxes can jump to $9,000. That's a $3,000 difference. Annually.
The same house.
Yeah, but on a monthly basis, it's significant. It's almost $300 a month, right? Yep. So that changes the payment drastically, right? So again, it goes back to payment. Like, what are you comfortable paying for your housing, right? And you really need to hone in on that with people. So I think it's great that that we do that.
And what we do is we make it easier for people and say, okay, you want to be at a $3,000 payment, you should be shopping for a house at this price range if this much are in taxes. If the taxes are this much, you have to reduce, if the taxes are $1,000 more a year, you have to reduce your purchase price by X amount.
Yeah.
And we make it easy. right?
I have
Like,
people
now
too,
you know.
they'll come and say, hey, well, okay, maybe I'll just buy a condo instead.
Mm.
Right? Like, because the taxes are so high, I'll just buy a condo. There's slightly lower taxes,
Yeah.
but there's a catch there too, right?
Yeah, absolutely. The catch is your HOA fee,
Yeah.
right? Your HOA fee, and that can vary drastically too from condo association to condo association, anywhere from, $200 or $300 a month to well over $1,000.
Yeah.
So,
Easy. Yep.
just call the HOA fee the taxes, because really that's what they are, right? They're all the maintenance to maintain the roads, to keep the lights on, to pick up the garbage, all the things that your tax dollars pay for that you're not paying
Right.
are absorbed by the HOA fees.
Yeah.
So that's something that people want to consider too, or need to consider when they're talking about their overall housing expense.
Yeah. And ultimately, when we're pre-approving a buyer for a property, what we're figuring out is the maximum payment they can afford. Right.
Yep.
We're not figuring out the maximum purchase price they go to. We just figure out, hey, what's the maximum payment this person could afford? And then once we know what that is, we can back into the maximum purchase price of any property once we consider the taxes, the insurance, the association fees, et cetera. Right. So, again, focusing on that payment is so important. And then, also the touch on the quality of pre-approval, right? Like pre-approval is a term that gets thrown around very, very loosely in our industry. Everyone's like, oh, just go online, get a pre-approval, go call my, mortgage guy, get a pre-approval. But what is a real pre-approval? Like, talk to me about that for a second.
Yeah, so a bona fide pre-approval is what we do at Inform, right? Before we issue a pre-approval letter, we protect those pre-approval letters, because that's our reputation when we send it out, right? So we want to make sure that when we're issuing a pre-approval letter and we're telling a buyer to go out and shop and spend time and ask your realtor to spend time and money researching properties for you, setting up appointments, taking you out on the weekends or at night when you're done work, we want to make sure that that pre-approval is accurate and real. So
what makes it real? Like that's where I think people get hung up. Like,
what makes it real?
Are you having a thorough conversation with the person? Like, are you asking them a lot of questions? Like, what makes it a real pre-approval?
Yeah.
What makes it
a real pre-approval is when you've submitted your documents and it's actually been underwritten and approved by
It's been underwritten. Okay. Which is what normally happens after you sign a contract to buy a home, right?
Correct. Yeah. Most lenders don't do that. I touched on that a little bit earlier, but what most lenders do is have that conversation on a phone, right? Or what most lenders do is have that conversation, ask you a bunch of questions, ask you how much money you make, ask you what your debts are, maybe pull a credit report, maybe not, and issue you a pre-approval letter.
That's not a real pre-approval.
It's
right.
Not
that is really a pre-qualification. Yeah, that's the technical term for that, right? Because it hasn't been underwritten. It hasn't been approved in advance or pre-approved, right? So to issue a real pre-approval, you have to have a credit decision made, right? You have to have third-party verifications done, bona fide underwriting. So it's a trip to the underwriting department, right?
Yeah, absolutely.
Which ultimately costs money to do, right?
Correct.
So I think that gets to the heart of why the pre-qualification was invented and why the larger retail and bigger banks don't do full bona fide pre-approvals, frankly, because it requires an investment of time and money, right?
Yeah, and it's a tremendous amount of money. It's not cheap to originate a mortgage or even to originate a pre-approval. But we feel that the quality of service and the ease of the transaction for the clients when they issue all those documents up front and we pull a full credit report and we submit the file to underwriting, which means we're paying people, right? So we have salaries that we have to pay and health insurance. And, the more files you bring in, the more people you need to maintain your level of service. Pulling actual credit reports versus soft pulls that some lenders like to use, or they'll pull one of the 3 required credit agencies. When you apply for a mortgage, you need a tri-merge credit report. Some lenders will pull one credit report to save money. Well, not every credit report or, Experian, Equifax, TransUnion, not all of them are going to show all of the trade lines. So it's these little shortcuts that lenders are trying to save money on up front that cost the borrower time and money and potentially the loss of the transaction when they actually go under contract and they start doing all that work. We want to do all that up front. And I think that's the reason that we've been able to grow our business the way we have. through strictly word of mouth, right? Like we do very little advertising, if any. We don't do any advertising, right?
I think that's a huge part of it, right? We do know advertising. It's word of mouth, referral based lending, and because we're not advertising, there's no cost to advertise. There's no cost to market the business. So it gives us the ability to reinvest those dollars in the actual underwriting process. And, that's where the bigger banks, fall flat, right? They have to market the company. They have tremendous advertising expenses. They're paying for Super Bowl commercials and TV commercials throughout the year.
Yeah.
Whereas we're not doing that. The independent mortgage banking side is focused on the one thing that they do and do well, which is originating 1 to 4 unit residential mortgages. And instead of spending money on advertising, we're investing in the process. And, that's really the key. It's always been interesting to me, the pre-qualification. I also go, where'd that come from? How'd that start? Right. And it started because it was invented by the banks to protect the banks, right? They needed a cheaper way to go about getting people some sort of answer, right? When they initially contacted, hey, my real estate agent said I need to get a pre-qualification or pre-approval letter. And that's great. So they can scratch the surface, they can have a conversation, they can minimize their time, expense, and investment, but it comes at the expense of the consumer's time and really the real estate agent's time as well. I can't tell you how many agents I've talked to over the years that have taken people out shopping with a pre-qualification letter or what they thought was a pre-approval letter, only to find out after the contract was signed that the person doesn't actually qualify to borrow the money. Yeah, and they get frustrated. Not only does the consumer get frustrated, but the real estate agent gets frustrated. And, that whole process that is created and done backwards to protect the lending industry, not the consumer. And that's where, if you work with independent mortgage bankers that actually offer and perform legitimate third-party verified bona fide pre-approvals, it makes all the difference in the world. It saves everybody time, money, and aggravation by just putting in the actual legwork up front to get that pre-approval done.
Yeah. And it can go the other way too, where they can tell people they're not qualified. I just had this experience. A client was referred to me through actually the title company because they had lost the deal and they didn't understand why. And the lender they were working with, first-time home buyers, so they were, very green. They didn't understand the process much at all, but well-educated people, great jobs, excellent credit. And they were told they needed a minimum down payment of 10%. And they didn't understand why, because they knew there was, 3% down for first-time home buyer programs available. There's FHA. There's various programs that they could have qualified for, they felt. And they did. They easily did. They applied with us, and we approved them for a 3% down conforming mortgage for first-time home buyers.
What was it at the first bank that turned them down? Why did that bank require 10%? What was the issue?
They don't know.
Was it an overlay? Could it?
It must have been. And that's what I explained to them. I said, it sounds like this bank has overlays.
Right.
I believe it was a credit union, which there's a place in the market for credit unions in certain scenarios, but they're also very conservative.
Yeah.
Right.
Yeah.
So
credit union is a great example of a retail lending outlet, right?
Yes.
It's offering its programs with its guidelines and its rules. And for maybe the credit score was just below a threshold that triggered in their world, a requirement for a 10% down payment, but that didn't exist in, conventional or government underwriting world. So, that's a great example. People just don't know that, there are multiple avenues of financing. So again, if you are turned down, especially if you're going to a big bank or a bank that you have your checking and savings accounts with, or, a retail outlet like that, there are other avenues to go explore, which you will most likely qualify for. I tell people all the time, there's probably a loan program out there for you, regardless of how bad your credit situation is or income situation is. It's just a matter of, do you have enough money to put down, and can you, handle the rate that comes with it, right? Because there are, I know we talked in the beginning about subprime, but there is a new version of that, right? For your, not typically qualified buyers, your subprime buyers, the non-qualified mortgage world, right? So these are great programs too. Why don't you touch on that for a minute?
Yeah.
Because
So
I think a lot of people don't realize that that's a thing now again as well.
yeah, I think there's a lot of people that don't realize it's not a thing. Non-QM, right? Non-qualified mortgages. So somebody who can't qualify through traditional means, right? W-2s, pay stubs. A lot of our self-employed borrowers fall into this category, right? Because being self-employed, what's one of your main objectives in life is to minimize your taxes, right? The taxes you have to pay to the state and federal government. So you're going to make your income on your tax returns look as low as possible. So what can we do to overcome that? Well, there's bank statement loans that we can look into, right? Somebody can qualify based on their business bank statements. They have an X amount of cash flow. We can derive income from their cash flow from their business bank statements and qualify them for a loan in that regard. Or if you're looking at an investment property, a great product that I think we use on a very regular basis is what's called a DSCR, right? A debt service coverage ratio loan. So you're purchasing an investment property, it's going to generate rental income. The rental income can be used to qualify for the mortgage, right? Now, you mentioned subprime and non-QM. They're very different. Subprime had almost no qualification requirements at all. It's like the joke was, hey, if you had a pulse and really just a pulse, if you were breathing, like the old mirror under the nose test, right? Put the mirror under the nose. If if it fogged up, they were approved.
Yeah.
Non-QM is not like that. It is, although it's reduced documentation, it is still more stringent.
What does
Right.
non-QM stand for?
Non-qualified mortgage.
And what's a qualified mortgage?
Qualified mortgage is what a traditional loan would be, right? Like anything that meets guidelines of Fannie Mae, Freddie Mac, FHA, USDA, VA. Right?
Okay.
That's a qualified mortgage. You're submitting all your documents, full documentations, W-2s, pay stubs, tax returns if needed, versus non-QM. It's not qualified. It's a reduced documentation, but still has stringent requirements. So it's not super easy the way subprime was, 25 years ago, where everybody got a mortgage. Literally everybody could get a mortgage, regardless. There was no checks and balances on anything with subprime. With non-QM, there is. Underwriting's not as easy as it may appear to be, but it's absolutely doable, and it's a great product that makes a lot of sense for a lot of people.
Yeah, so it's a loan that's not going to be sold to Fannie Mae or Freddie Mac or collateralized and securitized into a mortgage bond. It's going to be sold to some other third-party investor in the mortgage market. But there's reduced documentation options like the bank statement program you mentioned, the DSCR loan you mentioned. That's a great one. Did you just say that you can qualify based on strictly the rental income?
Correct. Yeah, the rule of thumb is if the rental income, the fair market rent, not what you think you're going to get, not what, Airbnb is advertising, but what the verifiable market rent is. If that's equal to the mortgage payment, the total mortgage payment, right? So principal and interest, taxes, insurance, HOA fees, everything that's associated with the housing payment, you could potentially qualify for that mortgage based strictly on the rental income.
Oh, that's great. Yeah. And so if the rent covers the nut, then you're approved.
Yes.
Easy
I
way
wish
to
it was
put
that easy, but
Yeah.
but it's not. But yeah, that sums it up. If
And
rent
then
covers
the
nut,
value
you're
has
cool.
to be there, obviously, right? The
Yeah,
appraised
yeah,
value. The
the
sales
value.
price has to be supported by the
And
value.
there's asset reserve requirements. So there's some additional requirements. It's not as simple as, hey, the rent's there.
Well, there's also programs, DSCR programs, where the rent doesn't have to cover the nut, right?
That's
so,
true.
like
Yeah.
the rent can cover 75% of the nut.
Correct.
Or it could also be a situation where the rent covers more than the payment, right? It might cover 125% of the payment. And
Yeah, which
I
is
think of
great.
those loan programs, that impacts the interest rate and the costs too, right?
Correct.
If it's all risk-based, right? So like if the rent is covering more than the mortgage payment, it's not as risky a loan. If the rent's only covering 75% of the mortgage payment, then there's more risk. So there's going to be a higher interest rate and fee structure on the loan. But the point is there's no tax returns needed to qualify, no income from the borrower, right? It's all qualified on the merits and basically the P&L of the property itself, right?
Exactly.
But that's only available for investment properties, right? Not primary residences.
Correct. Yeah, you can't use rental income to purchase for a primary residence.
Because you're not going to have any rental income from a primary, right?
You can, well, if it's a multi-unit, you may.
True. But if
But
for the
you're
most
most
part,
likely
if it's a
not going to do a
single family,
DSCR loan if you're buying a multi-unit primary residence, right?
Right. But very cool that those programs exist. You know, the bank statement program too. I mean, for self-employed borrowers, that has been a game changer, you know, because to your point, accountants are paid to do their job and minimize tax liabilities for self-employed individuals. But that's counterproductive, shoots them in the foot when they're trying to qualify for a mortgage because they have no income on paper or little income on paper. So by looking at the deposits coming into the business, bank statements, the cash flow for the business, and applying an expense factor on that and using that as income to qualify, it makes it a lot easier. Sure, you know, these non-QM rates we're talking about are a touch higher, you know, so maybe a bank statement loan might be a point and a half higher over a prime rate, but you don't have to pay the income tax needed to qualify for the prime rate mortgage, right? So
exactly.
it's, you know, when you think about the tax dollars that they're saving versus the slightly higher mortgage interest they're paying, which if it's a primary residence is tax deductible anyway, it becomes almost a no-brainer, you know? But again, these programs too, these bank statement programs, Neil, these aren't offered through your typical retail lenders, right? And your big banks. Like these are products that are found in the broker channel and the mortgage banking channel, right?
Correct. Yeah. The bank statement loans in particular have been a blessing for many of our self-employed clients, right? Especially those that own multiple companies that have multiple tax returns and K-1s and Schedule Cs. And, you know, it just becomes a very convoluted underwriting, and the documentation requirement for somebody who owns multiple companies can be a little bit overwhelming. So a lot of people do prefer, like, just get me the loan. Here's 12 months of my business bank statements. You can see I made plenty of money. Can we do it like this? And the answer is yes. Yes. And the vast majority of the time. As long as they have good cash flow and they have a, you know, solid, productive business, it's a great, great option for self-employed borrowers. And I've done that for primary residences, vacation homes, and investment properties, the bank statement loans.
Yeah, I have a client right now that has 18 businesses.
Yeah,
and I did a mortgage for him, you know, years and years ago, and it was voluminous trying to document his income. Working with his bookkeeper and his accountant. You know, he got wind of the bank statement programs, and he's like, Chris, that's all we're going to do from now on. Just bank statement. So it makes too much sense.
Makes his life easier. Yeah.
Oh yeah.
And I don't think the pricing is that much worse.
No, it's not. No.
Yeah,
I mean, depending on your credit score, you know, I've seen about a point higher, you know, than what you would typically get on a conventional mortgage.
Which is still lower than where rates were 3 years ago.
Yeah, I mean, right now you're going to get something in the, you know, low sevens instead of the low sixes without paying points, right? You know, you can get lower if you want to pay fees and points, but that's really not that much higher in the grand scheme of things, especially, you know, when you factor in the tax savings of not having to qualify with tax returns. Yeah,
and that's an interesting point you brought up too. You know, rates are in the low sevens instead of the low sixes right now, which historically, if we take out the 10 years from maybe 12 years from 2010 through 2022, being in the mid sixes is really a great place to be. Right. Yeah. And we've talked about this in the past. If we draw a straight line from pre-COVID to today, the trajectory is almost exactly there. Like this is where rates would be. Right. I remember having closings in January of 2020 where we were at, you know, 5 7/8 or even 6%, the same place we're at now, roughly. So without COVID being there, rates they're at where they're at, right? That was an anomaly, right? Worldwide shutdown, first time anybody's ever experienced anything like that. Was it necessary for rates to go that low? We don't know, but you know, would we have been fine without the reduction in rates? Probably. But the fact is, we did it, and people took advantage of that, and we got spoiled, right? And a lot of people are now clinging on to their, you know, 2 3/4 or 3% interest rates. Yeah. Which brings us into another issue we're dealing with right now. Yeah, you have 2 3/4 or 3% on your $400,000 mortgage, but you're also carrying $50,000, $60,000, $75,000 in credit card debt, which a lot of people are right now.
At 25%.
Yeah, 25% or higher. Or higher. It's right up to 30%. Even 31, I think, is the maximum that credit card companies are allowed to charge. So if you have $75,000 or even $50,000 at 25%, how much is that costing you a month? Thousands. So how great is it having, you know, your 3% on your mortgage when you're paying more in interest on your credit card debt? Yeah. It just, it doesn't make any sense.
brings us right back to payment, right? Just so we
Yeah,
were talking about
exactly.
payment when we were qualifying for a house. You
Mhm.
care what the payment is. Like, yeah, even after you own a house, if you have credit card debt and you have a mortgage, you're not writing the interest rate on the payment, right? You're
Yep.
writing, or on you're not writing the interest rate on the check. You're writing the payment on the check, right? So if you have a 3% mortgage rate and you're paying $2,000 a month for your housing, but you're paying $4,000 to your credit card debt, and then combined it's $6,000. If you could refinance that and consolidate at 6% and cut the payment in half,
Yeah.
you're saving $3,000 a month. Then the question is, what do you do with that money, right? Like, if you take the $3,000 a month and you put it towards the new mortgage at the 6% rate, probably pay it off in like 10 to 12 years, apples to
Exactly.
apples, right?
Yeah.
But people are psychologically stuck on, oh, I can't increase my mortgage rate from 3 to 6. I'm going to double my rate. But they're not factoring in
Yes.
their blended rate. Like, if you blend that 3% rate with your 25% rate on your credit card and your installment loans, what are you really paying? Probably 12, 13, 14% on the total debt. So that's an interesting, thing we're seeing, Neil. The psychological factor of giving up a lower rate to go to a higher rate is challenging, even when it results in improved cash flow.
Yeah. So one of the biggest objections we get is, well, I don't want to go back to a 30-year, or I don't want to be paying my house off for, the rest of my life.
You hear that all the time. Yeah.
All the time, right? But to your point, if we're saving you $2,000 a month and you're already making these payments, right? Maybe things are a little tight, but if you're making the payments happen and your goal is to pay off your house, right? You got your mortgage in 2020, we're in 2026, right? You've had the mortgage 5.5 years. So you're 5 years in. What if we can show you a way to actually pay the mortgage off in 12 to 15 years, keeping your cash flow exactly the same way? If your goal is to pay off your house, let's show you how to pay off your house. Who cares what the interest rate is? Is it really that important? Right?
Yeah.
Or is your cash flow more important? Is it nice to be able to take a vacation a year, once a year, take your family away, maybe go out to dinner once a month? But you're strapped right now. You can't, because you're paying $2,000 to $3,000 a month in credit card debt. Like, what are we doing? Right?
And people have the equity in their homes to alleviate that stress and pressure.
Correct.
Right. Because of the rapid appreciation rise that we saw during COVID. So the silver lining for a lot of people that have debt and own homes is the equity, but you can't access it unless you are willing to refinance, to tap it, which involves giving up that lower rate. But overall, it's there, it's relief, it's within reach. And people come to terms with it, at different times, but eventually the weight of this debt, which is still rising, right? We're still accumulating debt as a country at an alarming pace, and the rates are not coming down on the revolving debt. So people reach their breaking point. But again, if you have equity in your home, take advantage of it, right? Again, we're not writing our interest rate on our check. We're writing our payment, right? So
correct. Yeah.
if you can save money on a monthly basis, then do it. Whether you put it back towards the mortgage or whether you put it in a high yield savings account or a money market, invest it, keep it liquid, you'll have access to it and you'll have breathing room. So,
So another thing we do as an independent mortgage banker, because we don't offer those ancillary products, we don't sell insurance, we don't sell life insurance, we don't sell long-term care. Some of the things that I talk to my clients about when we do these refinances, say, hey, where are you guys at for retirement? We're going to save you $3,000 a month. First of all, you have life insurance to protect your family. And what type of retirement accounts do you have set up? Well, most people, the answer is minimal to zero, right, for retirement. So then we're able to refer them over to a trusted financial advisor, right? Which we have nothing to do with, other than we have a relationship with financial advisors because they have a lot of the same mindsets that we do, right?
A lot of what we do is financial advising, right?
Yeah, it is. Yeah. We offer people financing plans for their homes, right? But their goal is to put people in the best possible financial situation. And that's what we want to help them do too. And we do it unlike the large retail banks who want to sell you that product, right? You can't go into Bank of America without getting slapped in the face with a Merrill Lynch ad, right? So we're not doing that. I'm going to refer you my financial advisor or somebody from his firm in most cases, and they're going to set you up and say, hey, here's what we can do for you now. And I've had clients that have been immensely thankful for that, who have put them on the right track, protecting their family with life insurance, or setting them up for retirement so they can actually not have to work someday, right?
Yeah.
That's everybody's goal, is to stop working, right? Pay off your house, stop working. So that's what
Yeah.
we want to do. We want to help people get there if that's what their goals are.
Yeah.
Right.
Yeah. I always tell people, we don't sell financial products. We're not certified financial planners in that regard, but we do, like a financial planner manages assets. We manage liabilities, right? We manage cash flow. We manage debt, restructuring debt, which creates more cash flow for you to use with your financial planner to create long-term investment in wealth and put yourself in a better financial situation. The home is a keystone of a financial plan, and we play a big role in that. And yeah, there's plenty of equity and plenty of strategies to be used to better people's financial situations right now. And, we tell them all the time, don't let your low interest rate hold your equity hostage. Put it to work for you, utilize it, put yourself in a better financial situation, relieve the pressure, and look to the future. You have it there for you. Take advantage of it, and don't be burdened by the debt any longer. But this is great points, great conversations. The last thing I really want to bring up, and it's on the heels of all this, is really affordability, right? Like, we're talking about the cost of everything rising, people having to put purchases and acquisitions on credit, the cost of, that credit increasing over time, the rise in interest rates post-COVID, the appreciation of the housing industry and home values. So what's it look like today for a first-time buyer, that's trying to step into the market, purchase their first home and start to establish their own wealth? Like, what are your views on their outlook as we go into 2026? Is it going to be any easier for them? Are there any tools coming out that could help facilitate them? Are there any tools available today that can help them obtain a mortgage and step into home ownership?
Well, yeah. I mean, things that are available right now, there's some great first-time homebuyer programs, right? The one that I like is the Home Ready or Home Possible programs that's offered by Fannie Mae or Freddie Mac. That there are income limitations and income requirements, but if you qualify, it's only a 3% down payment, which is one advantage, right? So it's a very low down payment. The other advantage is if you qualify for that program, you're getting the same interest rate and monthly mortgage insurance as if you put down 15%, right? So, typically the riskier the loan, the higher interest rate somebody gets, right? So less money down generally would equate to a slightly higher interest rate. With that program for first-time home buyers, that's not the case. You're getting the very best interest rates available in the market because you're a first-time home buyer. So I love that one.
So it's reduced interest rates, reduced mortgage insurance,
interest rates,
and a reduced down
mortgage
payment.
Yep. Yeah. So that's a phenomenal program. And I try to get people placed in that program as much as possible. There are some down payment assistance programs. They can be somewhat cumbersome, but it's good for somebody who has no other option, right? So we have a great 100% financing program for FHA. Interest rate on it is slightly higher. The great advantage to that is you will take a higher interest rate. You'll have no money down. And if we can marry that to a seller credit for them to cover closing costs, I've closed quite a few of those where people have moved into the home for just a few $100s out of pocket.
Mm-hmm.
Now you're taking a higher rate, but once you've made 6 payments on that mortgage, you're eligible for a refinance where you can refinance down to current market rate. So really it's a short-term loan, knowing you're going to be able to refinance out of that higher payment in the very near future.
It's a great way to step into a home with very little money out of pocket. You're paying a little more monthly for 6 months, but then you're able to do that simple refinance, streamline refinance, right?
Yeah.
No appraisal, no income, no credit, and just get out of that higher rate 6 months later.
Yep. Exactly. So that's a great program for first-time home buyers. And there's been a lot of talk in the news about a 50-year mortgage, right?
Yeah, talk to me about that. I've been hearing a lot about that myself.
Yeah, you've been hearing a lot about that?
Yeah.
So a 50-year mortgage, what does it mean? How much does it actually save somebody? Well, the first thing we know is longer-term mortgages generally have higher rates. So if a 50-year mortgage is introduced into the product, you can expect to pay a slightly higher rate. What's the benefit? It could be anywhere from a couple to a few $100s a month in a reduced payment. Um, the challenge to a 50-year mortgage, there's a couple things out there. The first challenge that a lot of people are overlooking is we talked about earlier about qualified mortgages.
Right.
Right. In order for a 50-year mortgage to really be viable and be affordable and be competitive with where 30-year terms are right now, it would need to be a qualified mortgage. Qualified mortgages have a definition that's in the Dodd-Frank bill of a term of no more than 30 years. So the definition of a qualified mortgage would need to be modified. And I assume
there's an exception to that, right? Is if the loan is saleable or purchasable by Fannie Mae, Freddie Mac, or insurable by FHA, then it would fall under the guise of a qualified mortgage. So really, we either need to change the definition or we need Fannie or Freddie to announce that they're going to buy these loans, right?
They're going to buy those loans. And in order for them to buy them, what do they need to do? They need to issue a 50-year mortgage-backed security. Right now, the maximum term for a mortgage-backed security is 30 years. So in order, again, for it to be viable and be affordable and be on par with where 30-year fixed mortgage rates are now, they need to securitize those and turn those into bonds. So they would need to issue a 50-year bond, right? So that's probably the biggest hurdle. How big of a hurdle that is? Probably not that much, really. They just need to do it and issue it and then find buyers for it. So yeah, 50-year mortgage coming down the pike, possibly. It could happen in 2026. What's
They're
the downside?
Interest heavy too, right? Now, like when you look at the split between principal and interest on a 50-year payment, it's pretty much interest only for the most part.
Oh, sure. Well, 30 years the same way, right?
Yeah.
But
even more so, right? With
even more so on a 50-year, yeah. So then you got to weigh, okay, what are the long-term costs, right? If your goal is to pay off your house, which is unlikely, right? How many people actually pay off their homes?
Yeah. Well, I think that's a good point. Most people, think, oh, I'm going to get to the end of my mortgage one day. The average 30-year fixed rate mortgage is refinanced roughly every 3 years.
Correct.
And that's going back probably, data for close to 30 years.
Mm-hmm.
So, mortgages are a financial tool that help us afford something expensive at a reasonable payment, right? And as we go through different stages of life, our financial needs change, our cash flow needs change. And so the mortgage changes, right? So I haven't had a client that I can think of in my career, which is, now going into my 21st year, same as you, I believe, that has paid off their mortgage. I don't think I've had a single person do that. Like on an average, I've had people who have made lump sums and wiped out their mortgage at some point, but for the majority of people who are making mortgage payments, they've never actually gotten to the end of a 30-year mortgage. Have you had anybody make all 360 payments?
No. Well, I haven't been in the industry 360 months yet.
Yeah, there you go.
But no, I mean, what do we talk to people about? We build these long-term meaningful relationships with our clients. So we're there for them whenever they have, major changes in their life. People are refinancing for various reasons, right? Not so much now, but rate and term refinances. People took advantage of much lower rates during COVID, right? So people who got mortgages in between 2016 and 2019 or late 2020, early 2020 were in the upper 5-6%. Rates went to, the mid twos. We were refinancing them. They were potentially adding 5 years back onto their mortgage, right? Kids go to college. A lot of people tap into the equity of their home to pay for their kids' college, right? I mean, if you're, if Landon comes home and says, hey, Dad, Princeton wants me to play soccer for them.
Full ride, baby.
Full ride. Princeton, nobody pays to go to Princeton, right? But if you did have to pay, it's $100,000 a year, right? Minimum. Yeah. So you're tapping into your equity there to send your kids to school potentially.
Oh, man.
And other things change too, right? On the other side of the spectrum, people get divorced. So you got to refinance the house, right? So, the idea that somebody's going to get a 30-year mortgage and pay it off is highly unlikely. It's just not the way we live.
People upsize and downsize and they change their housing for many reasons. So it's not, to your point, it's not something that is typically paid off.
No.
But if a 50-year mortgage can make it slightly more affordable, especially for a first-time buyer, then it's a good thing, right? It gets them into home ownership, gets them into owning an asset that, has historically appreciated at 4% a year for roughly 80 years. So from an investment standpoint and a wealth building standpoint, there still is a lot to be said for home ownership. So Yeah, we'll see. We'll see how that plays out in 2026 and if they can get that put together. But Neil, listen, in the interest of time, we're coming up on the hour here. I just want to be mindful of that for our listeners. But this has been a great conversation. I appreciate you coming on and sharing your insights and your experiences. Again, 20 plus years in the mortgage industry has shown you quite a bit, exposed you to a lot of different scenarios. And, what I take away from it is you're really passionate about what you do. You have an overwhelming sense and drive to help people buy homes and really understand how to borrow money. So, that came through loud and clear for me. So I appreciate that. And again, thank you so much for taking the time to talk with us and come on the show.
Yeah, no, I appreciate being here, Chris, and thank you. Appreciate
All
your
right.
time.
Well, guys,
Looking forward to doing it again.
Yeah, absolutely. Yeah. And we'd love to have you back again, Neil. I'm sure we will. All right. So until next time, stay informed, stay connected, and keep originating. We'll see you soon.